Hey guys, welcome back to another video. So I'm excited to be back to do more of this analysis. If you've watched our previous video, we talked about where we've been, what we've been doing, and the plans we have for the last quarter of 2025. Can you imagine? It's already the end of the year. Okay, so September is here. We're about to begin the last quarter, which starts in October, November, December. So September marks the end of the third quarter, then we enter the fourth and the last quarter of the year. And that's how 2025 is gone. So I hope you've been trading well. Hope you've been doing what needs to be done. Now for me moving forward, I want us to work sort of together. So I got an account. I have an account with Paperstone. So if you don't have an account with Paperstone, click the link below. You need to have an account with Paperstone, because if you have an account with Paperstone, that's the account we'll be using together as a team to be doing live trading sessions. We've talked about this in the podcast, we've explained about it, but that's why we'll be hosting and trading our live trading sessions. So if you have an account, that's how you get access to that video, a live account, and all live analysis and live sessions. Okay. But other than that, we'll be having a lot more other contents that will be coming, and we'll be following a theme, and more on this later. But this week's theme, we're talking about risk management. As August comes to an end, as we finish this month of August, risk is important. As we prepare to go into September and to prepare for the last quarter of the year, end the third last quarter, start the new quarter, we need to have proper risk management. Then from there, we'll come and talk about other things. So we'll get into mine and look at mine a bit. But other than that, I want to show you also the difference of having, and this is what I was explaining earlier, a prop firm account and a live account, and how you should fuse the two together. They follow different risk managements depending on the rules that govern the certain prop firm that you're trading. Remember, when you're trading your own account, you determine your rules. The principles are yours, the rules are yours. Okay, the trading plan can be tailor-made and can be played around depending on the season, the environment, the volatility, the volume of the certain market, the pair you're trading. But when you're trading prop firms, you sort of need a consistent, lesser risk to trade on that one and to be consistent. That one, you can't really tweak it as much, especially if you're trading a prop firm that has very tight risk management rules like FTMO and the likes. Now, in this video, I'm going to share you my plan for trading the FTMO account. So I have a new $10,000 account that we'll be using for the live trading sessions. That would be that specifically. I have that account specifically for that. So just a small account, we grow it. So I want something that is similar to most people, not a $100,000 account and people are trading a $5,000 account. There'll be too much discrepancy. So I want something that is more or less similar to one another. Then also my Paperstone account, which we'll be looking at. Okay. So without further ado, let's get right into what I have for you today in terms of risk management. Okay. So as you can see on my screen, this is follow our YouTube page. So our YouTube page, we're about to change it up. This is I'll explain this more on a different video of how you can be following the playlist and how you can learn from our YouTube channel. If you look at it now, everything is everywhere. So we have over 700 videos. Okay, not too far away from hitting 1,000 videos. So it's taken us 700 videos to reach 12,000 subscribers. So if you haven't subscribed, please, my friend, subscribe. We're here to help you. We're here to show you content that makes sense, okay, and things that can help you. So more on this later. Now let's get into my risk management plan for 2025, trading the Paperstone account and the FTMO account. Okay, now I'll do this in a two-part video. So this is the first one. Then I'll do it in another video to finish the second part of my risk management plan. I will show you as it is. So I'll show you things raw. I'm not going to filter. I'm not going to hide anything. What I show you here is what I do. So the first thing you have to look at when you're looking at risk management, and we'll come and talk also about my trading plan. We'll talk about this in a different video. If you scroll down, you can see how long my trading plan is. Okay. So we'll talk about this in a different video and how I use my trading plan. But I have a trading plan aside, then I have a risk management plan aside. So most people, you find they put it together, but I believe risk to be something that you should go in depth. I don't think it's a 2-pager or 1 paragraph that you should just write. It's something you should look at deeply, and you look at it of how I put it on mine. And note, I haven't even finished mine. Remember, when you're coming up with a trading plan, risk management plan, it is always work in progress. It will never be complete. It's always changing. You're always tweaking here. You're always testing things out. Come back to the drawing board and change things. So first off is my risk per trade. Okay. I risk 1 to 2% per trade, depending on confidence and setup quality. Okay. Confidence and setup quality. Now, I can't say I focus too much on confidence. All the time when you're about to take a trade, most of the time, you're normally confident about this trade. So I don't rely on my emotions to determine what is the risk I'm going to take. It depends on the setup. I don't have a big range in terms of risk management changes, okay? So it's quite a small gap. So, however, for my FTMO account, I cap it at 1.5% risk, aligning with the risk guidelines on FTMO. So if I come to FTMO, if you come to their page, so if you do your research nicely and find the account, at FTMO, we actively monitor activities of our traders and observe trends on how traders approach trading in general. We generally recommend risking 1 to 1.5% per or any given trade idea. Okay? Per trade or any given trade idea. So 1 to 1.5%. Now, what happens if you trade 2% risk? Okay? Now, the problem is you might trade and everything will seem fine. But once you pass the challenge, let's say you take, because if you have a 2% risk, the first challenge you're supposed to pass by getting 10% in the first evaluation. So if you do that, if you risk 2% and you have a risk reward of maybe 1:3, okay? So first trade you take, it works, you're going to make 6%. Second trade, if it works, you're going to make 12%. So you'll pass even before that trade actually ends. Then you go into phase 2, you take another third trade, which you're supposed to pass by 5%. That one trade, easily you pass. So let's say you have a 3-winning streak and you pass your challenge like that. Everything will seem fine until you pass the challenge and it's time for you to be refunded and have your live trading account. That's where the problem comes in. FTMO are going to flag you and say, this person, trader X, was trading well, okay? They took 3 trades and they were able to pass 2 phases of the challenges, the challenge and the evaluation. Now, they will mark you, put a red flag and tell you you're over-risking on your account, so we're not going to fund you your money. They even rather refund you your own money that you paid than give you a live account. Because if you're given a live account, remember, you'll be refunded and still have a live account. So you need to follow those rules strictly. These are hidden rules that you don't find here. And mind you, look, if you pass the evaluation and the challenge and the evaluation, making a 15% return, my friends, that is not an easy feat. Okay? Go wherever you want to go. Go to those traders who say it is easy to pass a challenge. It is easy. My friend, it is not easy. If you're following the right steps, FTMO, you're following the right risk management rules, risking 1% to 1.5%, and to pass that challenge is not an easy task because markets are not just there to give you money. You have to look for opportunities. You have to go through the process of trading, having that trade management, psychology, and all that. So you want to follow the rules before you even start. So risk is very important. So for FTMO, you need to be very consistent with the rules, very consistent with the risk management that you're taking. 1 to 1.5. If you go beyond that, my friend, there might be some problems in the end. Ken can tell you his story. So the time he had an account, not with FTMO, it was with another prop firm. Or was it FTMO? I'm not sure. We've had many accounts and we keep talking about them all the time. So I don't know which one was which. Maybe he can explain that. Where he did everything well, passed his challenge in a record-breaking time. When he was about to just get funded, okay, and get refunded, they told him, my friend, you are risking too much, you didn't follow our rules, and they refunded him his money. At the end of the day, I paid that money. So I'm not looking. The best case scenario, at least, is to get refunded. Because last year, if you don't know, we lost a lot of money in the prop firm space after many prop firms went under. You remember I had funded engineer. I had about 400,000. No, I had 300,000 with funded engineer. The funded trader, I had about 400,000. They also went under. I remember the 300 account and a $100,000 account. So I had a $700,000 account, which went kaput, just like that. They just disappeared. So at the end of the day, you want to cover that risk, okay? In terms of how you're going to trade. That wasn't a trading problem risk. That was a capital trading problem risk, if you get what I'm saying. And I'll talk about that later on. That's when I'm emphasizing on FTMO and accounts, because at the end of the day, part of the risk you're taking is paying for those prop firms. That's risk, okay? Putting your money in that account, that's a risk you're taking, okay? So you really have to know what you're doing before you go any further. But I'll talk about that later, okay? So my risk is always calculated on starting balance. This is important. Unless the account equity drops below that. In that case, I risk based on current balance to avoid inflating losses. I'll explain that in a few. Let me just finish this sentence. I do not compound or increase my risk as the account grows. I maintain risk consistently over growth. Now, you really need to have a goal in mind. Now, my goal is different. Many goals of many traders the goal of most traders is to make money. For all of us, that's equal. We all want to make money. But the question is, how are you going to grow that money? Now, for us here at Financial Hub, we follow the proper method of risk management. So we don't risk 5% of our accounts, be it our personal account or also prop firm account. We treat our accounts all equally. So I don't come and say, since this is a personal account, I want to flip this account, let me risk more. Those habits you build with the small account as you grow your account are the same habits that are going to build you when you have the big account. Now, when you have a big account, you have $1 million, you don't want to risk 10% of your account. Okay? You don't want to do that. You want to follow the proper risk management style. So for me, I keep it consistent. Live personal account, live prop firm or challenge prop firm, I keep it the same. So what do I mean by my risk is always calculated on starting balance? Let's say I have let's say $10,000 account for the prop firm account that I'm saying I'm going to share with you guys live trading. If you're risking 1%, you're risking $100. Okay, so I'm always risking $100 of that account. Now, when my account starts to dwindle, starts to go down, let's say I'm down to 9,500. Okay, I've lost 5% of my account. Okay, I am going as much as I'm going down. Even I go to 9,800, 9,700. I'm going to risk that 1% of the current balance. I will risk $97 if my account is at a current balance of 9,700. I won't risk $100. Okay, so if my account is going lower, I'm always reducing my risk depending on the current balance. So I'll always take 1% of anything below $10,000. If it's at 10,000 going lower, I'll always take 1% of that initial balance. Now, what happens when my account begins to grow? I do not compound. I do not increase my risk. So let's say I have $11,000. Maybe I've not yet withdrawn. The account is still there. Someone might say, okay, Caleb, are you going to increase your risk to $110,000? $110. Of course not. That's not how I approach my risk, because the more you start increasing your risk just because you're seeing profits, the sooner your account is going to go down. The only time I'll increase my risk, let's say using a prop firm account, is when I've been scaled up. Let's say I've traded my account well, they scale up my account by 50%. Let's say it's at $10,000, I'm scaled up to $15,000. Then I'll take my risk to $150. But as long as the starting balance is $10,000, even if I go up to $12,000 and I haven't withdrawn, I won't start risking $120. Okay? So I hope you get what I'm saying. And same thing, I do it the same with my own personal Paperstone account. I do not go increasing my risk. I keep the risk maintained. Now, for the personal Paperstone account, I have certain goals. So the goal sometimes is normally just to grow the account. But sometimes maybe I've made money, I want to withdraw. That's fine. But when I'm increasing, when maybe just a portfolio, I want it to grow, I have a certain account that I just want it to grow. Okay, I want this is a track record account. Then I have certain targets before I increase my risk. So let's say I have $1,000 personal account. If my account is at $1,100, I won't increase, because if you have a $1,000 account per risk, that's $10. Okay, if I go to $1,200, for example, I want to increase my risk to $12. No, I'll give myself targets. I'll say, for example, let me get to $1,250. Okay, so a 25% increase. Then I'll increase my risk. Okay, and I want to see that consistency. If I have another, I get to 1500, then I'll increase my risk. So it's gradual, not just immediate. So risk management of current balance is very, very critical. Okay. Then we'll go to number 2. Okay. Losing streak protocol. Now, traders, let's be honest with one another. We all have losing streaks. Okay. We all get losing streaks here or there. There's no time you'll go without telling me. I'm sure most of you have gotten 5 losing streaks. I think the most I've gotten, there was a time I had a crazy losing streak. It was about 7, 8 losing streaks just zikifuatana. Now, if you're risking 1%, that means if you have a losing streak, you're going to be down about 8% if you lose 8 trades in a row. Okay? If you're risking 2%, you're going to be down 16%. Now, remember the mathematics we've done before in these videos, and we'll put it in the playlist so that you can watch it together. The more you go down, the harder it is to come back up. If you lose 50% of your account, you need to make 100% back or more of the current balance of the account for you just to go back to break even, the starting point. So if you had $1,000, you're down to 500. You're going to need to make 100% return of that 500 account balance for you just to go back where you began, not even to be profitable. Now, if you went down 50%, what is going to guarantee you that you'll be up 100%? Unless you just take some crazy risk and close your eyes and hope for the best. And since markets are in a bull market and you just take a buy and it works in your favor, you think you're a genius. That's not trading. Trading needs you to be systematic also when you're losing. And you need to see that beforehand before you actually take the risk. Don't get to that 16% loss, then start saying, okay, guys, I need to cut my risk. Get down to 8% loss, then you say, I need to lower my risk. No. Plan before you start. A bad plan is better than no plan. If I incur 2 consecutive losses, I immediately cut my risk by half. Now that's my personal risk management plan when it comes to losing streak. If you've watched a couple of my videos a few years back, maybe a year or 2 years ago, if you've watched a video, I'd say that if I have 5 losing streak, or my students are familiar with this because I taught them in class, if I have a 5 losing streak, then I'll cut my risk by half. Okay, so let's say I'm risking 1%. Now, I noticed over the years of trading, the more you get deep into your losses, the harder it is to come back up. So these days I cut my loss or I reduce my risk very fast. So if I have 2 trades in a row that have cut my risk, that have given me a loss, I cut my risk by half, at least to get things back to normal fast. Because if I'm risking 2% of my personal account, now remember, I risk between 1 to 2% of my own Paperstone account. I never go beyond that. So between 1 to 2%. FTMO, prop firms 1 to 1.5. So you always have to do the calculations right. So 2%, if I lose 2 trades, you see I'm already down 4%. Now because of that is because I have this losing streak. Okay? So I tend to cut it early. Or even if I took a 1% risk, I'll cut it early. Let's say I have 2 trades in a row, also at 2% loss, I'll still cut my risk by half. As long as I'm not counting the cumulative loss, I'm counting the number of losses. Remember, when you're having a losing streak, you're never looking at cumulative loss. You can have you can have 1 trade loss and you lose 10%. Then you start saying, okay, guys, I need to cut my risk. No. You need to have in terms of numbers, not in terms of value and amount. Don't get me wrong. So don't come like and say, I'm waiting till I lose $100 of this $1,000 account before I cut my risk. No. Say, I'm going to have this number of trades. Losing is going to determine my losing streak. Now remember, all this goes back to the backtesting data that you have, which I'll talk about later with regards in another week when you have a theme of backtesting. This week's theme is risk. So you have to follow what was said in the plan. I stay at this reduced risk level until I have recovered the losses and demonstrated consistency. I never increase my risk during winning streaks. Okay, I talked about this up here. Emotional euphoria can lead to recklessness and reckless decisions. And I aim to stay neutral regardless of performance swings. So whether my performance is good, whether my performance is bad, I want to maintain consistency in terms of risk management. Okay, so I hope you've enjoyed that, and I'll get deeper into it. But make sure you come and watch the next video, which I'll be posting soon, to cover the next session in terms of risk management. And now if you look at my risk management, it goes much deeper. Now I won't get into everything and I won't explain everything because we tend to go much deeper in our weekly webinar. So make sure to also join our weekly webinar, which we'll be announcing every week, and get notified. Follow our social media platforms, Financial Hub, Forex Academy, and where we'll be keeping you updated. Actually, it's Financial Hub Academy. We've sort of rebranded to just keep it Financial Hub, rebranded because we noticed these days we cover a wider range of markets. I personally don't trade the Forex market anymore. I don't trade any currency pairs. At the moment, I only trade commodities and stock markets with a focus on indices. That's what I look at, and I'll talk about that more. If you come for a webinar, I'll be sure to explain that much deeper. And remember, our webinar, we tend to answer questions, we tend to be very interactive with you guys and give you quick, immediate responses and updates about our trading, about the market, and about everything. So those are best. What you're watching now is pre-recorded videos, but the live trading sessions and the live webinars are the best. So without further ado, hope you've enjoyed that one, and I'll see you in the next video.